Good morning, everyone, and thank you for joining us for this new webinar hosted by Alquity. My name is Marc Rugel, and I'm responsible for Alquity Business Development. Today, we are excited to delve into insight from Mike's recent journey through India. After spending 2 weeks having 52 meetings in 4 cities, plus traveling to the hinterland to visit store companies, Mike is here to share his findings in a concise and informative 20-minute webinar, which will be followed by a Q&A session. A bit about Mike. With over 25 years of experience, he's one of the most seasoned portfolio managers in the Indian asset class. In the 90s, he served as a portfolio manager for the Peacock Indian Fund at Barings. In 2014, Mike joined Alquity and has been leading Alquity Indian since its launch and has delivered constantly exceptional performance. Without further ado, let's get started. Mike, over to you.
Thank you, Mark. Good morning, everybody. The first thing I'd like to talk about is that India is not one homogeneous market. There are actually many Indias, and that's really important to understand as that gives us alpha generating opportunities. The map we have here shows the most common primary language throughout India. And maybe starting with the West, with Mumbai, 26 million people live in the greater Mumbai area. That's larger than many European countries. And Hindi isn't the major language there, it's Marathi. Going down south to Bangalore, again, Hindi is not the main language there. And having seen the development of Bangalore over the last 30 years, parts of it now are on a par with Singapore. However, the Hindi heartland, the grey-blue area at the top, of which Delhi is the center, is very different. Now, firstly, Delhi has 46 million people in the greater Delhi area. That's just an immense number of people and an immense economic engine. But the Hindi heartland, which is Modi and the BJP's heartland themselves, their political power base, is nowhere near as developed as the South. For example, stable electricity was only in many towns and small cities 5 years ago. So we think it's really interesting as a focus of structural growth to find companies that are focused on this area and as it levels up with the rest of India. Now, on the next slide, we show a further change that we're already seeing in India. This slide shows the split of Indian households between income levels, high, upper middle, lower middle, and low. And 26% of the population in 2021 were in the high or upper middle incomes. That's predicted to increase to 45% by 2030. Now, that's 100 million people entering this upper middle and high-end consumer base. The lower middle will increase as well, but it's nowhere near as powerful. So companies that are leveraged into that top pit of the population pyramid very much are going to see strong structural growth over the coming years. And we find that really exciting and an alpha generating opportunity. Now, on to the next slide. This just kind of recaps the journey that we've been seeing in India. It really is becoming too big to ignore. In the emerging markets index, India was only 6.4% 10 years ago. It's now 18%. It's the second largest market in the index. And it's gone over that same point from the 10th largest stock market by globally by capitalization to the 4th largest. India is increasingly being seen as a standalone allocation in people's portfolios, much the same way that China was historically. And I think that's a message that's only just beginning to resonate. And we're on chapter 1 of a multi-year book here in terms of the growth of India. So now coming on to the macro environment on the next slide. The chart on the left shows quarterly GDP growth, the purple bars, and annual GDP growth, the green bars. And we saw last week the latest quarterly GDP number of 8.4% in India, significantly beat expectations. and we expect to continue to see 6% plus GDP growth over the next few years. That's one of the strongest growth track records that we expect to see globally, and certainly one of the most consistent. On the right-hand side, the blue line is interest rates, and the red line is inflation. Inflation's coming down, but interestingly, we never saw the spike in inflation that many Western countries had. In India, it's dropped down to 5%. We'd expect that to be a little bit lower over time. And that to lead interest rates, the blue line, to come down again in the next 12 months to add a further kicker to the growth story. Now, turning to politics on the next slide, we have national elections coming up in the next few months. Modi absolutely will win again. And let's look at how that is panning out. On these pie charts, starting on the left, the first one is the 2014 election results. The BJP, Modi's party, had 282 seats and his allies had 54, giving him a strong majority. That increased further in the 2019 elections to 303 for him and 49 for the allies. We've had a couple of polls recently. The last one from the Times showed 366 seats for the BJP and its allies. And from India Today, it was 304 for the BJP and 21 for the allies. So again, a strong majority for Modi. And when I was in India the last few weeks, I did a very unscientific poll by speaking to taxi drivers, etc. And without any exception, everyone expected Modi to win again. There really is no sensible opposition. And the interesting thing was, even in Chennai in the south, where Modi is not popular and the taxi drivers wouldn't vote for him, they still absolutely expected him to win. When this happens, we expect to see further business-friendly policies, and that will be a further catalyst for the market and the economy that really isn't priced in at this point. So politics is going to be a positive catalyst over the next 12 months, in our view. Now, moving on to the next slide and valuations. This is probably the most consistent question I've had on India over the last 30 years. It's never been a cheap, i.e. low PE market. That absolutely has not been a bar to making very exceptional returns. So let's delve into this a little bit more. The chart on the left shows India's PE over the last 10, 15 years or so. And it absolutely has re-rated, and deservedly so, given Modi's tax reforms, given the infrastructure spending that's unlocked the potential that India always has had and is now being realized. But those PEs are not stretched. We're one standard deviation above the 15-year average. We're not on a peak. This is absolutely not a bar in terms of PE. Now, perhaps more interestingly, the table on the right. Why does India have that high PE? And this data comes from Jefferies, the broker. And you can see there India's PE of 22 times, its EPS growth for this year of 17%, giving a PEG, a price to growth ratio of 1.3 times. India has a high PE because you have very strong growth, not just for 1 year, but for 3, 5, 7 years, going back to some of those charts we looked at the start. So on a PEG basis, India is already cheaper than Korea, Japan, Mexico, the UK. China at the top is cheap, but is that a value trap? We have to ask ourselves. And Brazil, Taiwan, and Thailand, these are cyclical opportunities. They aren't structural. India has these multi-years of growth, whereas these have 1 or 2 or 3 years of cyclical opportunity. So India's PE is never going to be low, but it absolutely is not expensive. You're not, in our view, overpaying for growth, and we're able to see value within that context. On to the next slide, I'd like to talk about something that perhaps differentiates us very much from the many of the other Indian funds out there, is that we're focusing on India's dynamism. This wheel here, starting on the left-hand side, whether it's organized retail, travel, in India theme, which is gaining momentum, financing India, building India, or India on the move. All these stocks in our portfolio benefit from these structural changes. And you can see a couple of pictures from my recent trip on the right-hand side. Now, I'd now like to delve into a couple of these areas in a little bit more detail, starting on the next page with travel, first of all. The slide on the left shows the number of passengers flying domestically in India, going back the last 25 years or so. It was rising very strongly. Obviously, we had a dip from COVID. We're now above COVID levels, and you can see there the expectation of almost a doubling by 2030. That's being facilitated by Modi and infrastructure. The number of operational airports has already increased by a third and is expected to increase dramatically again over the coming years. And over 1,000 aircraft are on order by Indian Airlines. The growth potential we see here is huge. And this plays very much into that upper middle demographic that we talked about at the start. This part of the population is growing, they have money to spend, and they want to spend it on leisure. So on the next slide, this is an example of how we're playing this in the portfolio. Lemon Tree Hotels, a market cap of just over $1 billion, not in the index. They've just opened India's largest hotel in Mumbai. Demand growth of 9.7% is forecast to outstrip supply growth for the industry of 5.9% over the next 5 years. And India has only 1/26 of the economy rooms of the US. Now, we believe in kicking the tires, seeing things with our own eyes, and this is one of the hotel rooms in their new large hotel that we stayed in a few weeks ago. Very impressive. On the top right, this shows the evolution of hotel room growth in India over the last 20 years. It's gone from 26,000 rooms to 178,000 rooms already, and we're going to see much stronger growth. But the upper mid-scale and the economy, this is where it's targeted for the Indian middle class rather than the high-end tourists. We've seen a 24 times increase in hotel rooms, yet demand still massively outstrips supply. And Lemon Tree is very much focused on this area, which is why we like it. In terms of ESG, Lemon Tree is one of the largest employers of disadvantaged people, and they want to ramp that up further to 30% of their staff by 2026. And very conservatively, we see over 30% upside in our base case. And following the trip recently, we'd expect to revise this up going forwards. So now moving on to the next slide and talking about the retail side. Organized retail has increased dramatically over the last 15 years or so. As we've seen with many different areas, the introduction of tax harmonization has started to make India more of a unified country than it was before. And organized retail has gone from 7% to 19% over that time. And again, you can see some of the stores there, not just in the big cities such as Mumbai or Chennai, but also in smaller towns such as Meerut, which is 2 hours outside Delhi, where we visited to get a much better sense of what's really going on. Again, this plays into the growth spurt of the part of the population that's having more money. And an example of this on the next slide is Metro Brands. This has a market cap of almost $4 billion, again, out of index, and it's one of India's largest footwear retailers. India, perhaps surprisingly, has one of the lowest per capita consumption of footwear globally, as you can see on the right-hand side, with just 1.9 pairs of shoes per year consumed, less than 3.2 in China, let alone Indonesia, Brazil, or France or Germany. So again, much potential there for growth. The footwear industry is now 35% organized in terms of retail sales. So more than the overall retail industry from the slide I showed you before, but still a very low number, giving you a second leg of growth. Now, what's really interesting about Metro is some of their recent tie-ups. And this is one of our advantages by having an in-depth understanding of India, but also a broader emerging and global perspective. Metro's tie-up with Fila, we believe, will supercharge growth. We've seen what this brand has done over the last decade in China and Korea, and expect to see the same thing happen in India. Equally, their agreement with Foot Locker brings multi-brand trainer retail to India in a way that just does not exist. It is completely unique. And that upper mid segment is exactly the demographic that will really be excited about these opportunities. In terms of ESG, Metro aims to recycle one pair of shoes for every pair it makes, and we see almost 60% upside to our base case there. So again, a really exciting stock that's out of the index that plays into that structural opportunity. Now, moving on to the property sector on the next slide. Top left, India's urbanization rate is rising. We've seen that happen in China, Indonesia, many countries, and India's following the same path. On the right-hand side, the household size is declining. In the same way we see in the West, we have nuclear families, much smaller family units, resulting in increased demand for housing again. But that's where the similarities end. Bottom left, this is inventory of property in India. And in complete contrast to China, inventory levels are actually declining. Demand outstrips supply, and we're 2 years into a 7-year cycle. So there are no ghost cities. Indian demand is incredibly strong. And bottom right, the affordability of housing has actually improved. Unlike the West, where it's becoming increasingly out of reach, in India, more and more people can now afford houses. As you've seen, that affordability ratio improve dramatically over the last few years. So again, the property sector really plays into that upper mid segment where we see the greatest structural growth opportunity. Now, on top of these structural themes, on the next slide, the rural economy has been weak for a long time, certainly since COVID. And we now can see signs of that recovery turning around and beginning to gain momentum. As many of you know, we donate 10% of our revenue at a firm level to empowerment projects in the areas that we work on. And one of these here is in India. And Suresh, our head of sustainability, visited that project last month. We hold consumer panels with the people that work there to get a different perspective on what products and services they're consuming and how they see the economy. And that very much gave us a signal that the rural economy was beginning to improve. And that's been confirmed by motorcycle volumes, for example. Hero is the largest motorbike company in the world, and we've started seeing growth there. And commentary from the CEO also demonstrates that the rural economy is going to give India a further kick on top of that structural growth that we've just talked about. Now, on the next slide, putting this together, we really believe, and you can see it here in these numbers, that our long-term perspective on India, having been investing there for almost 30 years, combined with that in-depth knowledge, really delivers the results. And you can see over virtually every period, we're top or second quartile versus our peers, and we've been winning awards pretty consistently over recent years. So our strategy, as I've outlined earlier, really delivers results over almost a decade through this fund. And that differentiation and success comes through onto the next slide. Our fund actually is less volatile than the index. It has a much better Sharpe ratio, risk-adjusted returns. This is done with a focus fund, about 35 to 40 names, and low turnover. We're multi-cap, as you can see on the right-hand side, with 46% of the fund in a market cap of below 10 billion and 31% in a market cap above 50 billion. And 21 of the names in the portfolio are not in the index. Now, this is really important. Our job is to deliver the best of India, whether that's large cap or small cap, whether it's in the index or not in the index. That's one of the things that makes us really different from obviously an ETF or many of our peers. And that's what's led to that really strong performance over almost a decade. So to conclude on the next slide before we pass on to Q&A, India's investment story is domestically driven, and that means it is relatively uncorrelated with other growth opportunities globally. Our ESG analysis and our Transforming Lives consumer panels provide unique insights. India is changing, and you have to focus on the next story, not the last. We're differentiated, we're multi-cap, and we're focusing on the best of India. That makes us unique in our view. And our strategy and experience deliver these consistent results. I'm sure there's many questions, so Mark, please open up the question lines.
Thanks a lot, Mike. So please, as you can see, you have a tab at the bottom of the screen, Q&A, so please do not hesitate to write them. So the first question that we have, does the infrastructure in India, electricity, sanitation, water, support the need for more housing in the short term?
Yes. Now, there's two types of housing. There's the organized sector, the property companies building apartments that we'd recognize here. India has plenty of land. You're seeing plenty of growth there. That's an area we've been adding to, and we're really excited about given those charts. But then in the smaller towns and cities, people build their own houses. So that creates strong demand for cement, for pipes, for wiring. And we're seeing good growth there as well. So yes, the infrastructure does support this. Much, much more needs to be done. When I traveled to Meerut outside Delhi, there was an amazing multi-lane highway for an hour and a half. It's comparable with any highway you'd see in Europe. You then get there and it's chaos. They're building a metro, they're redesigning the town. So we've had some work. There's a lot more to do, and housing will be part of that, and the infrastructure will support further housing. This is a multi-year story.
Thanks a lot, Mike. And can you a bit actually discuss about the case between China and India? You have obviously talked about valuation, but maybe also in terms of geopolitical and how actually investors should look at this maybe switch between these two major countries.
I mean, going back to the start of my career, that was kind of the takeoff for China. And obviously, it's made much of the population much richer. We've seen very, very strong growth for decades. And that seems to have come to an end. Whether that's temporary or not, time will tell. But China certainly has suffered from its demographic time bomb. The population is not growing, whereas India's is. And the government interference in the economy has caused a lot of problems, which are widely known. India, in contrast, is maybe 15 years behind China on that journey. India's always had potential, but it's Modi that's unlocked it, partly through harmonization of tax, reform, and infrastructure. And so I think India will follow a similar but different path in terms of growth, and it will be many, many years of 6% plus GDP growth. Now, the geopolitics is the icing on the cake. Companies want to move their supply chains or diversify them away from China to Vietnam, India, etc. And Modi's Made in India incentive schemes encourage that as well. So you have a structural story that's now being unlocked, that's gathering pace, good economics, good politics, and it now looks much better relative to China, which is something that certainly wasn't the case 3 or 5 years ago.
Thanks, Mike. Two questions. First one, can you give an idea of relocalization of supply from China to India? And the second one, you talk a lot about harmonization of tax. What does it mean concretely, please?
So I didn't catch the first one.
So can you give an idea of relocalization of supply from China to India?
Sure. So a number of electronics companies, for example, including Chinese and Taiwanese ones, have now opened factories in India itself. Now, that makes sense, not just for the diversification argument, but India has a large captive market. So if you can get the logistics right, the economies of scale right, you can service that market. You can then start exporting in the fullness of time, and you diversify your supply chains away from China. So again, it's the right policies at the right time as India now begins to consume. So Apple, for example, is building a lot of plants in China, in India, excuse me, for example. In tax harmonization, India was, as you saw in that very first slide, a patchwork of states and languages. And the treatment of various products was different in different states. That was harmonized with the goods and services tax, which made it much easier to make something in Mumbai and sell it in Delhi. It's not frictionless, but it's a lot better than it was before. And there's still some improvements to do there. That meant that the unorganized sector lost their competitive advantage, and the good, well-run, organized companies that we invest in gained market share from the unorganized, as well as benefited from the structural growth from India as well. So you have two legs to this story, and we've had some of that, but there's more of that to go. That comes back to why India is such a structural story and not cyclical.
Thanks, Mike. We have a specific question about the stock, which is HDFC. Obviously, it's one of our largest exposure into our portfolio. Can you give us a brief summary of what happened recently? What are our views? And if we are positive or not on the stocks?
So HDFC Bank is one of the most blue chip private sector banks in India. I remember meeting them almost 30 years ago, and they have gained significant market share over that time and are really, really well leveraged into the Indian growth opportunity. And unlike the public sector banks, they are run for shareholders rather than the government. Now, they've merged with their parent company, and that is going to be an even more formidable player going forwards. The share price has been a little bit weak over recent months as those merger synergies are taking a little bit longer to come to fruition. The question is it today? Is it 3 months? Is it 6 months? Is it 9 months? And I had the opportunity to quiz the CFO when I was in India the other week, and their communication has not been as great as we would like. We're absolutely convinced about the potential here. And the question is just when we start seeing that. Will it be this quarter? Will it be next quarter? We're long-term investors, and we're absolutely happy with our position in the company because it will deliver the growth we see. But obviously, you can't time it to the exact month, but we're reassured following our meeting.
Thanks, Mike. About valuation, you say that valuation are not stretched, but you can see, I can imagine difference between small, mid, or large cap. Can you elaborate on it, please?
Yep. I mean, I think the secret to India is finding good companies that have great ESG, good governance, are running the interests of all shareholders, have a structural growth opportunity that is not recognized by investors. So whether it's large cap or whether it's small cap, I think if you go behind the obvious candidates, you can always find really interesting companies that meet the criteria that are cheap. And you get that re-rating over time. Now, we have a position in a company called Astral Pipes. First met them in Ahmedabad in 2016. It's a pipe company, so it plays into that demand for infrastructure, housing, etc., and was significantly cheaper than other companies in similar sectors. Over the last 9 years, we've seen a 600% increase in that share price. Now, valuations are still giving us some upside there, but that's what I believe you can do if you have that long-term perspective, but in-depth knowledge. And following the trip, we've just added a electronics company, electronics retailer into the portfolio. They are cheaper than other retailers by a long way. Governance is great, and they focus very much on that Hindi heartland, which is now leveling up with the rest of India. This isn't covered by sell-side brokers. It's an opportunity that is mispriced. It happens to be small cap, but you equally can do the same thing in large caps. So not only is the overall market not extended, certainly not when you consider growth in other countries, but then within that, what we're really good at, we believe, is finding mispriced opportunities in a variety of sectors, in a variety of caps that deliver. So Lemon Tree Hotels is uniquely best positioned for the opportunity that we see, but trades at a 20% discount to the large cap company that's in the index. And we think Lemon Tree actually ticks the boxes for the structural themes much better than that other company. Again, a second example there.
Thanks, Mike. So we arrive at the end of the session. I wanted to thank you, Mike, for your great presentation, and thanks all the participants. Obviously, my VAM colleagues, Steve, Mark, Jason, and Somo, and obviously myself are remaining at your disposal for any additional question. We wish you a great day and goodbye.